So from that, Andrea, I'll let you take it over.
Okay, great. Thanks, David. Let me share my screen here. All right. This set up. Okay. Yes, and thanks everyone for joining today. I know it's not the most exciting topic during your lunchtime, but taxes are always necessary, right? So a little bit about me. Again, I'm Andrea Manion. I'm an accountant and tax preparer. I've been doing accounting and taxes for, I think, the last 15 years now. I've worked in government, corporate, and also public accounting, filing taxes. And then in 2014, I went off on my own and started my own company. So I help lots of, small businesses and entrepreneurs. I have a lot of clients in Inglewood here, and I also have a lot of clients out of state that I've actually never met in person before. So I have a few clients kind of all over in California and Texas and Florida and New York. So that I prepare their taxes for. So, and I am certified in QuickBooks as well. So I also help people with bookkeeping for their businesses. So that's just a little bit about me, and we'll go ahead and get started here for, we're going to talk about tax preparation for tax year 2021. And like David said, definitely if you have a question on the topic I'm covering at the moment, definitely put it in the chat because I don't want to forget about it. And we move kind of quickly through a lot of information within an hour. So definitely don't be shy to ask. All right. So I kind of just like to get to know a little bit about people who are here. If you want to give a shout out about if you have a business, what your business name is and type of business, and then you can just put it in the chat if you like. And then also kind of like your tax knowledge on a scale of 1 to 10, 1 being, not so much, 10 being a lot. I'm always kind of interested to see too how many brave souls out there file their own taxes and stuff. So if you do, you can also put that in the chat. And then if there's any kind of specific businesses or anything, then I know I can specify that as we're going. Realtor, nice. 4. Hey, you guys are 6 to 7 knowledge. That's pretty good. Anyone else want to say their business or communication? 5, very good. Two businesses and adding the third. Wow. You are busy, Debbie. Banker, 7. Wow, look at you guys. You guys are practically tax experts. I don't know why you're even here. Just kidding. Okay, we'll go on here. So I basically broke it down into 3 easy steps. Yeah, it sounds so easy, right? So we're going to go over knowing the tax deadlines, gathering all your tax documents, and then obviously go over the important stuff here, the qualified tax deductions and credits. Oh, Debbie says travel agent, physical therapist. That's right. Yeah. So if you do have a CPA that does your taxes, you will see that they will normally ask you a bunch of questions, right? So you kind of get used to that. Self-employed, do my own taxes. Nice. Retail store, file your own taxes. All right. You guys are brave. So hopefully going over some of these tax deductions and credits will help you then, especially those who prepare their own. So hopefully you're not missing out on anything. All right, so the tax deadlines I want to go over here. We have one coming up on the January 18th. So if you pay an estimated, tax payments, the 4th quarter is due January 18th. Now, I just want to let everyone know too that the quarterly estimated tax payments, those quarterly deadlines are not hard deadlines, meaning there's no interest or penalties for not making those. So as long as you send in any payment by that January 18th, that will count for the 2021 tax year. So I have a lot of self-employed, or business owners that will actually wait all year and then send in one payment in January for their taxes instead of doing 4 payments or whatever. They'll just save up and we'll just pay it in on January 18th. So you do have that option. You have 7 more days here. If you think you're going to owe, $1,000 more in tax, you can send in a payment and then not get hit with those estimated tax penalties if you think you're going to owe for 2021. And then January 31st, that's when all of the 2021 W-2 and 1099 forms are due. So that's when all those need to be filed with the IRS and all the governments. So normally, that's when we start seeing all of our tax documents come in the mail after those all get filed in early February. And then March 15th is the deadline for S corporations, the 1120S tax return, and then partnerships, which is the 1065 tax returns. Or if you have those businesses, you also need to file an extension on that day as well if you're not ready to file by then. So just be aware, if you are an S corp or partnership, yours is actually due March 15th. And then April 18th this year, that's when all the individual 1040 and any C corporation tax returns are due, or of course any extensions you may have to file for those, which you get 6 months. And then April 18th is also the last day to make any 2021 traditional or Roth IRA contributions for the 2021 tax year. So if you want to get in an extra tax deduction for 2021 before you have to pay your taxes, making an IRA contribution is definitely an option there, and we'll go over that later as well. And then May 16th, if you're a nonprofit 990, that's when your tax return is due, or you'll have to file like a 6-month extension if you're not ready to file. And also just want to let everyone know too, if you do file an extension on these days, that just gives you an extension to file and not an extension to pay. So sometimes people get that mixed up. Filing extension doesn't mean you don't have to pay your taxes due. It just means you have more time to file your tax return. So if you do owe money, with your business or individual return, even though you file an extension, you want to send in some type of payment. Otherwise, interest and penalty will accrue until you do finally file or pay that tax. All right. And then next, I just wanted to bring everyone's attention to that there is relief for the Colorado wildfires that happened. So the IRS announced that taxpayers in those areas, affected by the wildfires and straight line winds that reside or have a business in Boulder County, they have until May 16th to file individual or business tax returns and make tax payments without filing an extension or anything. So they have an extra month, people in those areas, to get that done. This includes 2021 individual income tax returns originally due on April 18th, and then as well as the business returns normally due on March 15th and April 18th. So if anyone's in those areas, I just wanted you to know about that. And then the next step is, of course, trying to gather and organize all your tax records, right? So I kind of listed a bunch here for you guys. But, normally there's, W-2s if you're an employee, any 1099s from banks or, other payers that could include unemployment compensation, dividends, stocks, distributions from a retirement plan, any state income tax refunds you're going to be receiving a 1099 for that you should look out for. Also on the unemployment, I just want to mention that if you did get unemployment in 2021, all of it will be taxable in 21. So I know last year in 2020, the IRS made the first like $10,200 of unemployment non-taxable, but they're not doing that for 2021. So just to let you know, any form 1099Ks, 1099 miscellaneouses, 1099 NECs, that's basically for self-employed or gig economy workers. If you got paid that way and are not employees, then you should have some of those. Any 1099 interest statements.
Andrea?
Yes.
So we do have some folks I know that are, I guess I would say they're home-based businesses trying to get started. They do some gig economy to supplement until their big idea takes off.
Right.
Is there, sometimes I'll get questions on this, but is there do they have to make a certain amount of money to have a 1099K miscellaneous whatever? Do you
Yeah,
know, is there?
that's a good question. So like if you're a contractor, not an employee, you'll be receiving a 1099 NEC if you were paid $600 or more from that particular business or individual. So if you made 600 or less, then you won't be seeing a 1099 for that.
Okay. And that includes, does that include per contract? I mean,
Right.
so if
Per
they did some
gig.
consulting for 2 or 3 different people and they made less than 600 on each of those, then they wouldn't necessarily receive that.
Correct. Now that doesn't necessarily mean you don't report it on your taxes either.
Yes,
So
yes.
just means you don't have a tax document. But the IRS says if you're like, self-employed or an LLC, if you made at least $400, they want you to report that. So again, just because you didn't get a tax document doesn't mean you don't have to report it and pay taxes on it. So
Great.
just be aware of
Thanks.
that.
I know there's a lot of argument. Thank you.
Yeah, sure. That's a good question. And then you might have a 1098s, interest for mortgage interest or student loan interest paid, other income documents. The IRS is really starting to crack down on the virtual currencies, Bitcoin and all that. So I know as a tax preparer, we are now supposed to ask everyone if they have any virtual currencies, whether they sold or bought any. Like the IRS wants to know about it now, obviously. So if you sold any, obviously you will definitely have to report that. You should be getting a 1099 and reporting any gains or losses there. If you bought any, generally there's no, tax transaction there. The IRS just basically wants to know if you have any. So, and then if you purchase health insurance through the marketplace, the Affordable Care Act, you should be getting a form 1095A, and that will kind of show, all of your premium tax credits and the costs for the insurance you paid. Because on your tax return, you kind of reconcile and see if there's a credit there. Sometimes you have to pay in more. So for those on the marketplace, you should be receiving that as well. And then this year, the IRS is sending out letters for the advanced child tax credit payments. So, if you're getting child tax payments, they started in like July sending monthly payments instead of the yearly tax credit. So if you did receive those monthly payments, the IRS is going to be sending you a letter on how much you received. Because again, you will have to reconcile that on your tax return, just because there'll still be some credit to take, but then you have to factor in what the IRS already sent you. And then they should be sending you another letter on the third stimulus payment that we received. So I think it was like March 2021. We received the third one. And so there is a recovery rebate credit if you didn't receive that or didn't receive enough. So the IRS is sending you letters on that, like how much you actually received. And then of course, if you are a business or self-employed, you're going to have your business financial statements done, or your spreadsheet or whatever, showing all your income and all your expenses for the whole year. what if you never received any stimulus checks? Yes. So that's what the recovery rebate credit is for on your tax return. So on your 2021 tax return, you want to be sure and say you received 0, and then you should get a $1,400 refundable credit. So you should get that when you file your 2021 tax return. So that's what that recovery rebate credit is for those who never received it or didn't receive enough. You know, there's some people that never did. So that's why they have that on the return there. And of course, the biggest one, if you are a business, is obviously getting all of your financial statements or your spreadsheets done with all of your yearly income and expenses. That's probably, the biggest challenge as a business, but hopefully you're doing it throughout the year. So it's not such a big task come tax time. And then if you're using software like QuickBooks or other accounting software, then generally that helps you a lot to get those done. All right. So we're going to go over some qualified tax deductions and credits. I have a whole huge list here. We're going to go over standard deductions or itemized deductions, charitable contributions, meals and entertainment, business mileage, home office, retirement plans and HSA, qualified business income, the recovery rebate credit, and then some other miscellaneous credits. So I generally listed the first 8 is generally what I see most of the time, and probably the ones with a lot of changes this year that I really wanted to go over. So we will be going over those. Standard deductions this year, if you're single, $12,550, married filing jointly, $25,100. And so forth. The married filing separately is the same as single, or if you're head of household, that's going to be $18,800 for 2021. And then if you're 65 age or older, your standard deduction increases by $1,700. If you're single or head of household, and if you are also legally blind, then you can increase that by another $1,700 as well. And then if you're married filing jointly, for you and your spouse are 65 or older, then your standard deduction increases by $1,350. So you'll see the standard deductions are very huge. They keep getting bigger every year. So itemized deductions, I know a lot of people get confused here, but so you either take the standard deduction or you itemize, whichever is greater. So you can't do both. So I will say probably 90% of people probably take the standard deductions now, because as you saw, they're huge, right? So unless all of your itemized deductions get above that standard deduction, you basically just take the standard deduction. So itemized deductions includes things like your mortgage interest payments, which is now up to $750,000 mortgages. So any mortgages above that, you're limited on the rest of the interest payments above that amount. Your property taxes paid, any state and local income taxes paid, sales tax, personal property such as car registration, all of those added together, they're going to be capped at $10,000 right now. For 2021, they are looking into changing that with the Build Back Better America plan that hasn't really been passed yet. But for 2022, know that might be changed. So that's something they changed a few years back, where they limited all that to just $10,000. And it kind of hurt some people, especially that has multiple houses and large property tax payments and things like that. But for 2021, it's still capped at $10,000. I think it's going to change for 2022, so we'll see. And then any charitable contributions, and then any out-of-pocket medical expenses that exceed 7.5% of your adjusted gross income. So medical expenses are very hard to deduct because they have to be over that 7.5% of your income mark. So say, for example, your adjusted gross income is $100,000 for the year. That would mean your medical expenses would have to be at least $7,500 plus to even start deducting. Okay. So medical expenses are very hard unless you have, a lot of huge surgeries or something happened that year that you paid out of pocket for, then that's the only time I really see that. And then another itemized deduction I wanted to bring up is casualty losses. So there is one for the Colorado wildfire. So this is, these are taxpayers in a federally declared disaster area, which Colorado wildfires were. They have the option of claiming disaster-related casualty losses on their income tax return. And if they do, then they have to put Colorado wildfires and straight line winds, and then a declaration number DR 4634-Colorado if you are claiming those. So for those in those areas that, obviously lost their whole house, they can take a nice deduction for that. Okay, so like all these, mortgage interest, property taxes, charitable contribution, medical, all that would all have to total up above those standard deductions in order for you to itemize. Okay, so I will say again, not a lot of people can do that anymore because the standard deductions are so high. If you're married and file jointly, that's like $25,100, right? So that's kind of a lot to try to itemize there. Okay. So normally, if you just take the standard, then, generally you don't have to worry about calculating any of this other stuff, right? You don't have to worry about looking at your mortgage interest, property taxes, medical expenses, or, your car registrations, all of that. If you know probably you're going to take the standard every year, then you don't kind of have to bother with those documents then to save you some time. All right, they do have a special thing for charitable contributions in 2021. So even though you don't itemize and you still just take the standard deduction, the IRS is giving you a $600 deduction for qualified charitable donations on top of the standard deduction for those filing jointly, and $300 for other filing status. So single, married filing separate, etc. So if you don't itemize, you can still get at least $600 or $300 deduction for your charitable contributions. And then after 2021, they're going to take that away and go back to, you need to be able to itemize in order to take any charitable contribution deductions. And they did that, to help during COVID. They still want people to kind of donate to nonprofits and stuff. So that's why they did that extra little thing, which was nice. And then also for charitable contributions in 2021, you can actually deduct up to 100% of your adjusted gross income, which is crazy. So usually before it was only 60% until the CARES Act was passed. So that means like, if you had a lot of charitable contributions, you could only deduct like 60% of what your actually income was. So if your income was 100,000 again, and say you donated all your money, 100,000, then you could only you could only deduct like 60,000 of that. But now you can do 100% for 2021 and get the full deduction. Meals and entertainment expenses. So there's a lot of changes here. Generally, the tax deduction was limited to 50%. For meals. However, in 2021 and 2022, actually, food and beverages will be 100% deductible if purchased from a restaurant. So, this includes like client meetings. If you go out and meet a client or prospective client or business partner out at a restaurant, that's 100% deductible. Those used to be 50% deductible, okay? Or if you order from a restaurant, like a meal for all of your employees, or for like a business meeting, again, 100% deductible. Or if you travel for your business and you go out to a restaurant, 100% deductible. So this is only temporary, again, for 2021 and 2022, and it was designed to help restaurants, that have been hit hard by the pandemic. So you can definitely take advantage of that for the next few years. Also, what's changed is entertainment expenses are no longer deductible. So things like show tickets, right? Or sports tickets, like if you bought Broncos tickets or theater tickets to take clients out to or employees out to, those are no longer deductible. Okay, so it's only food and drinks, no entertainment expenses at all. And then if you do go out and pay for employees or clients for something, just like to a Bronco game, say for example, just make sure your food and like your ticket purchases are separated. That way you can still deduct the food portion. Okay, so they have to be separated in order to deduct the food, but not the tickets or the entertainment part. And then of course, if you're ever audited, just know the IRS wants to see documentation, like who, when, where, business purpose. So a lot of times I just tell my clients to just keep that receipt you get from the restaurant, because you already have the day and where it was, and you just write a little note on top of that and just say who you met with, you know, that just write down the names and what like business you discussed. And then you can even just, you know, scan it, take it, you know, make it electronic, and then throw the actual paper away. So that's just in case of an audit.
So Andrea, this deduction for food will, it looks like you're saying will also be, what do I want to say, enacted or available for this year coming up that we're in.
Right.
So all of those, if some of our businesses haven't done that receipt for their food last year, then doing it this year would still benefit for them for all their client meetings.
Yes,
Great.
exactly.
So that's good to know.
Yes.
And it looks like, did you see that from Josh?
Oh,
everything goes on to the business card. Is it still necessary to maintain receipts?
Great question. I get that all the time. So yes, you still need receipts. Okay. And that's only in case of an audit. Okay. And that's because receipts give you the breakdown of what was actually purchased. So I know people have bank statements, credit card statements, etc. But what the IRS or state is going to come look at in an audit is, you know, what did you buy, right? Because if you deduct, say, office supplies from Office Depot or whatever, and just says Office Depot on your credit card or Office Depot on your bank statement, they don't know what you actually purchased, right? That's why they want to look at the receipt. They want to see the breakdown. Like, did you purchase gum or candy? And maybe that's not an office supply, right? So that's why they still want actual receipts. They just want to make sure, right? Or you didn't go to Walmart and like buy shoes and clothes and write that off as, you know, a business expense or something. So that's the reason why they still want receipts. Again, it's only in case of an audit, and they can be electronic. So, you know, you can just take a picture of your phone. A lot of places you can just get an email receipt to your email and just have it electronically, and you can throw the actual piece of paper away, as long as you're, you know, keeping some kind of documentation there. All right, business mileage. So again, you can take advantage. The IRS standard mileage rate for 2021 is 56 cents per mile. Again, if you were ever to get audited, the IRS likes to see a log that you have with like a date, the destination, the distance, and like the business purpose. So I always tell my clients, I always just use my Google Calendar because everything's already in there anyway. So like if I'm meeting the client, I'll have it in my Google Calendar and the location and who I'm with, right? So I kind of use that already. And as kind of my log, my Google Calendar is kind of my log, because I put like the addresses and everything in there, so I know the distances and everything. What if you work out of the house? How do you consider or claim? Yeah, perfect. We're going to go over to the home office next, I think. So we'll go over that next.
But Andrea, are you Angela, are you asking for mileage if you work out of your home?
Oh, got it.
So are those all, Andrea, are those?
Yeah,
Oh,
basically we work out of the house, but we drive to clients and on-site, plus material research, investigation.
Yes, those totally count. So driving from your house to a client's house, or, you know, your house to, you know, a client's business or a meeting. Yes, all those count. And that's what I do for myself as well, because I work out of my home. So, but there's a lot of clients, I actually go to their physical place of business. So all that mileage counts for me when I go to their business or I meet them somewhere. Definitely, yes.
And as long as you keep a paper log of
Yeah,
the
it
mileage,
doesn't even have to be a paper log. You know, there's a lot of apps out there too. Some of my clients use like Mile IQ. They just track, you know, on their phone the exact distance and everything. And you can have a paper log too. I have a client that keeps a notebook in her car and she literally like writes down with pen, right? She looks at her mileage and knows exactly, like, if this is a client meeting, she's gonna just keep a log in a notebook in her car. So it's like whatever you guys want to do, you know, paper, electronic, to keep that. And then obviously I tell people try to do it as you as you do it, right? Because it's really hard to go back and kind of create it for the whole year, right? You use Mile IQ, yeah. So a lot of my clients I see use Mile IQ and they just send me that report to do their taxes because I can see what the business mileage was and everything. And this is a huge deduction for you guys. So as self-employed business owners. So it's definitely something you want to take advantage of because yeah, especially if you're driving, meeting people, even if you work out of your home, like myself and others. So
Andrea, did you see the question above? Is it correct that the mileage deduction is not applicable if you are taking the standard deduction?
no, you can take the mileage deduction even if you are taking the standard deduction. Okay. So as long as you have like a business, right? Or you're self-employed, sole proprietor, generally you're probably filing a Schedule C. You can always take that mileage deduction, okay? The only time when you can't really take a mileage deduction is if you're an employee, right? So they got rid of, the IRS got rid of a lot of the unreimbursed employee expenses that you used to be able to itemize. So if you're just a regular, you know, W-2 employee and you had to drive somewhere, you know, that doesn't really count anymore. So this business mileage is specifically for those self-employed or with businesses, then you can take advantage of this, even if they just take the standard deduction. So I usually tell my clients too to record mileage on your vehicle on January 1st and then December 31st every year, because you also have to know the total mileage driven for the year. Because sometimes you have to do a calculation of like business miles divided by total miles to figure out what business percentage of expenses, because so you either deduct auto expenses or mileage, whichever is higher, but not both. Okay. But sometimes you may not know, right? So I just have a lot of my clients record both, you know, all their auto expenses and all their mileage, and we'll see, you know, generally which one is higher to take the bigger deduction at the end of the year. I will say most of the time, you know, if you're driving a lot, then mileage is going to be the winner and you won't have to worry about, you know, keeping track of your auto expenses if you do a lot of driving. But some people don't do a lot of driving, and so they'll take the auto expenses, right, to get the bigger deduction there. So that's a lot of confusion sometimes is, you know, it's either auto expenses or mileage, not both. It's one or the other. Home office deduction. So again, this is generally if you're self-employed or a business owner, you can take a home office deduction. If you're a W-2 employee, not really, because they got rid of all the unreimbursed employee expenses. So this is generally a deduction for, like I said, the self-employed or business to take. I will say the home office is kind of a red flag, so just be aware. You have to make sure the space that you're using is regular and exclusive. So you know, it has to be only for conducting business only. So you can't do anything personal in that area at all. If the IRS were ever to audit you, they're going to come look at that area and be like, oh, do you have a TV in there? Do you have a couch in there? And they're going to say, maybe that's, you're using personal stuff in there as well. Okay. So that's why it's a little bit of a red flag, because it's only, that space is only supposed to be used for business and nothing else. And it's also limited to your business net income. So obviously, if you're reporting a loss for your business, you can't take a home office deduction to get a greater loss. Okay. So you have to have some income to be able to get this deduction, basically. And most of it is allocated based on square foot. So generally you take the square footage of the space you're using for a home office just for business, and then the total square footage of the home, and you're doing that percentage calculation. And so there's two options you can take on a tax return. One is a simplified option, which basically just gives you $5 per square feet up to a maximum of 300 square feet deduction for the home office. And then there's a regular method where it takes all of your actual home expenses, which is like your mortgage interest, your property taxes, your utility bill, your water bill, your phone bill, right? Every single expense for your home, you add all those expenses up, and then you times that by the square footage percentage of the home office, which you get that, you know, dividing by the total square footage of your house and then the space. I will say I never use the regular method for my clients because it gets kind of tricky when you want to sell your home. So if you use the regular method, when you're using all of your house expenses, you're basically almost depreciating that part of your house, right? Because it's only used for business. So since you're taking all these expenses every year, you know, for that particular area of your house for your business, if you ever to sell that house, you'd have to basically add back all those, you know, deductions that you took with your and add that to the gain of what you sell the home for. So I never use that method. I always use a simplified method for my clients. So just wanted you guys to be aware of that. And also the simplified method is not as a red flag as, you know, taking all of your house expenses and then getting a percentage. So that's why I just do the easy $5 per square foot up to 300 square foot, and it's a lot easier and less audited. So I'll go over some retirement and HSA contributions. So for my business clients especially, we always do this to get an extra tax savings. If they owe tax, we'll always look at making a, you know, IRA contribution or something to get an, you know, an extra deduction. Because to me, it's always better to put money away for yourself than giving more to Uncle Sam, right? So I always look at this option for my clients with businesses at the end of the year to see, especially if they owe, see if we can get that down. So I just listed out the max contributions this year, you know, 401k, 403b, 457. The max contribution is $19,500 for 2021, plus $6,500 catch up if you're age 50 years or older. Simple IRAs, the max is $13,500 plus $3,000 if you're age 50 years and up. Traditional and Roth IRA, the max is $6,000 plus $1,000 if 50 years or up. And again, I want to remind you, there is no tax deduction for a Roth IRA contribution, okay? Because the Roth, you're paying the taxes now on it. And then, so when you take it out later in life, it's basically not taxed at all. So there's only a tax deduction on the traditional, okay? If you're looking at getting extra deductions, doing a Roth IRA is not going to do you any good. It's the SEP IRA. I love the SEP IRA for my business clients. It's a max of 25% of the employee's compensation or your W-2. You know, if your business is paying you by W-2, you can do a max of 25% of that, or 58,000. And because that limit is so high is why I love it, especially if you're an S Corp, or, you know, a business. I love the step IRA for that fact because it has such a huge limit, right? And we can play with that a lot to help save some tax at the end of the year. And then HSA is now a max of $3,600 for singles or $7,200 for families. And then if you're over 55, you can contribute an additional $1,000. So again, if you owe tax, looking at, you know, contributing to a retirement plan other than a Roth would get you a tax deduction. Qualified business income deduction. So self-employed people, owners of LLCs, S corporations, other pass-through entities like partnerships, they can deduct 20% of their qualified business income. Okay. Of course, everything is usually subject to income limitations, but that is a huge deduction. I think Trump did that one, but yeah, basically you can deduct 20% automatically or whatever your business income is for that. So definitely make sure you're getting that one. And then recovery rebate credit. Again, I wanted to emphasize, you know, our third stimulus payment checks, they were supposed to be $1,400 per person and $1,400 per dependent. So if you didn't receive a third stimulus payment sometime around March 2021, or you got less than what you should have received, you know, some people had babies in the year that obviously the IRS didn't know about. So if you had a baby in 2021, you probably didn't get $1,400 for them. So that's why on the 2021 tax return, there is a recovery rebate credit for that. So you can say, hey, I didn't get my stimulus payment, or I had a baby and I need $1,400 for them. Then you'll get that actual cash back on your tax return. And just to let everyone know, stimulus payments are not taxable at all. So the only reason why your CPA is asking that is, again, to get you that credit in case you didn't receive it. Okay. So don't worry if your tax preparer is asking you about that. It's not going to be taxed in your income. It's just to make sure that you receive that, because you'll get the actual money back if you didn't. And then I have some other credits going on here. Course, a child tax credit that went up in 2021. It's $3,000 for each child between 6 and 17, and $3,600 for children 5 and younger. And again, if you got some advanced child tax credit payments this year, then it'll kind of reconcile in your tax return to see how much you got, and then you'll get the rest of your credit on your tax return for that. There's an earned income credit, you know, for those who don't make a lot. If they have no children, they can get a 1,502 credit, and one child up to 3,618 credit, etc. And then there's a residential energy credit, which they actually kept, so you can deduct 26% of the cost of like solar electric property, solar water heaters, geothermal heat pumps, small wind turbines, fuel cell property, and all that. And that's only on your residential property. So that's not a business property, but that was extended through 2022. It was supposed to expire at 2020, but they have extended that for a little bit more. And then of course, there's like electric vehicles, plug-in vehicles, hybrid, fuel cells. You can get up to $7,500 federal credit. Except on Teslas or GMs, they're no longer available because so many people have bought them, so they kind of like ran out. There's now a tax credit, 26% for EPA wood stoves. Nice. Yeah. And then on the Colorado side, on the electric vehicle stuff, you can get up to $2,500 to $10,000 credit. So it just kind of all depends on which vehicle you bought, how much of that credit you can get. So with Colorado, it just all goes based on what actual vehicle you bought for that. But just know there's some really nice credits there. And also know that the Build Back Better plan, they're talking about increasing this as well. So if that passes, the federal tax credit is going to go, I think it's going to go up to like 12,500 instead of 7,500. So it'll be 5,000 more. Also know that there's some education credits. So if you have, kids in college or you're in college yourself, and they got rid of the tuition and deduction expense. So like they only have these 2 credits now, basically the American Opportunity Tax Credit or the AOTC, and you can get up to $2,500 per student, or the Lifetime Learning Credit LLC, and that's up to $2,000 per tax return. So
And Andrea, is that just for a qualifying university or college, or can continuing course credits work for those as well?
yeah, that's generally only like a college or university.
Okay.
If you have your own business, or you're self-employed, you can take, the classes for continuing education as a business expense. So you won't need to, this credit is basically only for like college or university.
Great.
Learning. Yep. And then I just wanted to throw in there too, the Colorado, on the Colorado tax return, you can get a deduction for, any 529 plan contributions. So if you have kids and you're saving up for their college, you can contribute to that and get a deduction, but that's only, you have to do that by December 31st. So if you didn't for 2021, it's too late, but maybe continuing on, that's something to think about too, to get an extra credit on the Colorado side. So, all right, I think I went through everything. Again, all these credits can have like income limitations and all these other things. So really just depend on, your situation and your income and what else you have going on. But I at least wanted you guys to be aware of it, so that maybe you might qualify for some of these. All right, any other questions? And I have my info in case you have any questions that come up later, because like I said, it was a lot of info. Within an hour, I could probably, I took a tax update class that was 8 hours and we still didn't get through everything. So 1 hour is kind of hard, but I went through most of the things I see a lot as a tax preparer, and a lot of the things that changed, mostly the big changes for 2021. So if anyone has any questions or you think of something later, you can definitely contact me later.
Great.